All right, let's get into it. Today, we're tackling a really big topic, something that traders and investors all over the world use every single day: technical analysis.
And it all starts with this one huge question. It's kind of the holy grail of finance, right? Can you really predict what the market's going to do tomorrow just by looking at a price chart from yesterday? For a whole lot of people, the answer is a resounding yes. And the way they do it is through something called technical analysis.
So what is this stuff, really? Well, at its core, technical analysis is basically the art of reading charts. The main idea is that every single thing you need to know, all the news, all the earnings reports, all the fear and the greed, it's all already reflected in the price. It's less about the company's fundamentals and more about the raw psychology of the market itself.
Now, what's so fascinating is that this entire field is built on just three big ideas. First, the market already knows everything, so it's all baked into the price you see. Second, price movements aren't just random noise. They actually move in trends. And third, and this is the big one, human nature doesn't really change. That means the psychological patterns we've seen in the past are probably going to show up again.
But where did this whole idea of reading charts even come from? You know, you might think it's a modern thing, born on Wall Street with computers and high-speed trading, but the real story starts much, much earlier, and not with stocks, but with rice.
Yeah, seriously, rice? Back in the 1700s, a Japanese merchant named Homa Munehisa was trying to figure out how to trade in a market driven by pure emotion. You had the fear of a bad harvest on one side and the greed of a good one on the other. So he came up with a way to visualize that market psychology, and in doing so, he invented what we now call candlestick charts. It wasn't until over 100 years later that Charles Dow, the Dow and the Dow Jones, brought similar ideas to the West, which really became the foundation for everything that followed. And then, in the 20th century, you got even more complex theories layered on top, like the Elliott wave principle, all trying to find the hidden patterns in the market's chaos.
And this just captures that journey perfectly, doesn't it? An idea that was born out of trying to understand the emotions of rice traders in Japan eventually travels across the world to become a fundamental tool in the very heart of global finance on Wall Street. It's pretty amazing.
Okay, so that's the philosophy, and that's the history. Now let's get into the practical side. How do analysts actually do this? Well, it all comes down to learning how to speak the language of the charts. The most basic, fundamental building block is the trend. That's job number one for any technical analyst. In an uptrend, what you're looking for is a series of peaks and valleys that are each higher than the last. And, you guessed it, a downtrend is the exact opposite, a series of lower peaks and lower valleys. You've got to know which way the river is flowing before you do anything else.
So, to see these trends, you use different types of charts. A simple bar chart is fine. It shows you the opening price, the high, the low, and the closing price. But the candlestick chart, our old friend from Japan, shows you the exact same information in a way that's so much more visual. The body of that candle tells you instantly whether the price went up or down in that period. It's a game changer.
But okay, it gets way deeper than just identifying the main trend. True chart watchers believe that within these big trends, specific repeating shapes and patterns form. And these patterns, they believe, are like visual clues to the market psychology that can hint at what's about to happen.
A perfect example of this is a pattern called the double top. So picture this. The price goes up and hits a high point. Then it pulls back. Then the buyers try to push it up again, but they fail at that same level. What you get is this classic M shape on the chart. For an analyst, that's a big red flag. It suggests that the buying pressure is running out of steam and the trend might be about to flip.
And here, you can see one in the wild. This isn't some clean drawing from a textbook. This is a real price chart, and you can clearly see that M formation playing out. The whole idea is that if you can spot this pattern as it's forming, it can give you a real edge. Of course, not everyone buys into this. For as long as people have been drawing lines on charts, there's been a very powerful, very smart counterargument that basically says it's all nonsense.
And that argument is called the efficient market hypothesis, or EMH for short. The part that directly attacks technical analysis is called weak form efficiency. And it's a simple, brutal argument. It says all that past price data is completely useless for predicting the future because it's already reflected in the current price. Game over.
So you see, you've got these two completely opposite worldviews. On one side, you have technical analysis, which says the past is the key to the future. And on the other, you have the efficient market hypothesis, which says the market has no memory and trying to predict its next move is like trying to guess a coin toss.
And the EMH actually comes in 3 different flavors, or strengths. The weak form is the one we've been talking about. It's the direct shot at technical analysis. But the stronger forms go even further. They argue that you can't get an edge even by analyzing public news, or in the strongest form, even with inside information.
So, where does all this leave us? We've got these 2 powerful, totally conflicting ideas. In the real world, who's right? What's the final verdict?
Well, here's the reality. Despite what academics might say, technical analysis is used every single day on every trading floor by countless traders, huge hedge funds, and major banks all around the globe. It's been around for centuries, and it hasn't gone away. That has to tell you something.
The people who use it will tell you it's not a crystal ball. It's a tool. It's a way to manage risk, to time when you get in and out of a trade, and to get a feel for the market's mood. But the critics? They say the only reason these patterns seem to work is because so many people believe in them. It's a self-fulfilling prophecy, not a predictive science.
And I think that leaves us with the ultimate question. When you look at a chart, are you really looking at a map of human psychology, a sophisticated tool for reading fear and greed? Or are you just doing what our brains are wired to do? Find meaningful shapes in what is ultimately just random noise, like seeing animals in the clouds. The debate is still very much alive.